$1.2 trillion in 3 months. And deal volume is actually down. The market is just hunting elephants right now.
Fake elephants, Nate. 30% of that volume is just tech giants buying massive equity stakes so regulators don't sue them. They aren't real acquisitions.
Hey, if I stroke a check for $30 billion to Anthropic, you can classify it however you want.
I call it a very expensive loophole. But sure, let's talk about why traditional software founders are suddenly terrified of the music stopping. The rundown.
$1.2 trillion in a single quarter. I had to refresh the terminal 3 times because I thought the comma was in the wrong place. We haven't seen this many $10 billion plus deals since 2008.
You need to look at the actual transaction volume, Nate. Volume is down. It's dropping. We're just seeing absolute monsters propping up the total dollar value.
Because everyone is terrified of missing the AI train. Equity stake purchases are making up nearly 30% of total deal volume right now. Big tech is writing these massive checks, like the $110 billion round for OpenAI, just to sidestep antitrust regulators.
I don't buy that it's purely a regulatory dodge.
Oh, come on, $30 billion for Anthropic? They're explicitly structuring these as minority stakes, so nobody has to file a formal merger notice. It is a textbook banker workaround.
Sure, the structure is a workaround, but the motivation is pure panic. Traditional software valuations are getting absolutely hammered by AI disruption. Software founders are quietly shopping their companies to anyone with cash before the music stops. Big tech isn't just dodging regulators, they're buying up the lifeboats.
Okay, fair point. But if you want a true recession-proof lifeboat, you buy trash. Casella Waste Systems just scooped up Star Waste. That's an easy $100 million in annualized revenue added to the pile. Regional consolidation play, trash never goes out of style.
Neither does infrastructure. Antin Infrastructure Partners just took Sapphire Gas Solutions off Apollo's hands. The infrastructure land grab is very real. While everyone looks at software, private equity is buying pipes and gas.
It's the perfect hedge against the AI madness, just like wealth management. Russell Investments just closed on Zurich Investment Management, bagging an instant $2 billion in retail funds under management.
And pharma is quietly having a moment too. Lupin just completed its buyout of VISUfarma from GHO Capital Partners. If you look at the data, European acquirers are significantly outperforming North America right now.
Which nobody is talking about because we're all too busy staring at the AI shiny object or looking for managed IT service providers to roll up.
Exactly. Which brings us back to the actual mechanics of those massive AI equity stakes you mentioned. I pulled the footnotes on how these governance structures are actually working behind closed doors.
I hope you brought your reading glasses for the fine print. The big one.
I just keep staring at this 1.2 trillion number. It makes zero sense until you actually read the breakdown.
It makes perfect sense if you realize every tech CEO is terrified of missing the AI train. $1.2 trillion in a single quarter, a 26% jump year over year. We haven't seen $10 billion plus deals stack up like this since 2008.
Right? But the actual volume of transactions is down. That's the footnote everyone is ignoring on Bloomberg this morning. We're seeing fewer deals. They're just massively, stupidly expensive.
Because they have to be. You're looking at the volume drop like it's a bad thing. It's not a cooling market, it's just a shift in the playbook. 30% of that volume is just equity stake purchases.
Calling them equity stakes is a very polite way of saying antitrust evasion.
Okay, sure, but it's brilliant antitrust evasion. Look at the scale here. You have OpenAI taking down $110 billion, Anthropic at $30 billion. You don't buy the whole company anymore. You buy just enough of it to lock up the tech, but not enough to trigger a heart attack at the FTC.
Brilliant is a stretch. It's a massive regulatory loophole, and the regulators are going to close it. You can't just park $30 billion in a competitor and pretend you're just a passive minority investor. The FTC is already drafting the subpoenas.
I strongly disagree. The bankers advising these deals are doing exactly what they should be doing. If you try to buy an AI lab outright, you spend 3 years in court. If you buy 49%, you get the models integrated into your cloud today. Time is money, Maya.
Real money is money, Nate. And speaking of real money, look at who's paying the price for this AI frenzy. Traditional software valuations are completely resetting. I was looking at the multiples yesterday. They're brutal.
Oh, the music is absolutely stopping for traditional SaaS. If your pitch deck doesn't have a credible AI moat, your valuation just got cut in half. Founders are quietly shopping their companies right now before the floor falls out completely.
Which is why I'm actually more interested in the infrastructure plays hiding behind all this AI hype. Antin scooping up Sapphire Gas from Apollo, Casella Waste Systems buying Star Waste for $100 million in annualized revenue.
Ah, yes, the classic Maya pivot from a $100 billion AI revolution to literal garbage collection.
Garbage generates reliable cash flow, Nate. Cash flow you don't have to defend in front of a Senate antitrust subcommittee. And by the way, those AI data centers need massive amounts of power, which is exactly why infrastructure land grabs are making up the rest of this $1.2 trillion.
You know what? That's actually a fair point. The picks and shovels are just as expensive as the gold right now.
Exactly. But if you want to see where the really smart money is hunting for stable returns, we need to talk about what's happening across the Atlantic. European acquirers are quietly eating our lunch this quarter. Voices.
I was reading the analyst notes this morning, and this one stat just jumped off the page. Nearly 30% of total deal volume right now is purely equity stakes, not buyouts, just stakes.
Because nobody wants to trigger an antitrust review. It is the coward's way out.
Oh, come on, it is a brilliant new playbook. Tech giants are terrified of regulators. So instead of buying these AI startups outright, they just stuff them with cash. We are looking at OpenAI at a staggering 110 billion, Anthropic at 30 billion. It is basically corporate dating instead of getting married.
It is a shadow monopoly, Nate. Look at the terms on these injections. The tech giants are getting exclusive cloud compute rights. They are tying the AI models entirely to their own infrastructure. They are buying the companies in everything but name just to skirt the law.
It is capital efficient. You get the AI capabilities, you lock up the partnership, and you skip the regulatory root canal. You are just mad you do not get a 300-page merger proxy to read.
Okay, maybe a little. But my real problem is what this is doing down market. Analysts are pointing out that M&A is now a pure survival lever for traditional software companies. AI is absolutely nuking their valuations.
The gossip there is wild. I talked to a former banking buddy yesterday who said half the SaaS founders in the Valley are quietly shopping their companies before the music stops.
Good luck selling a legacy software stack right now. Unless you have rock-solid recurring revenue and heavy cybersecurity compliance. Nobody wants it.
Well, nobody in North America wants it. But European buyers are a completely different story right now.
Wait, really? Europe is buying legacy tech?
European acquirers are actually outperforming North America across the board in recent metrics. They are hunting for exactly those managed service providers you just mentioned, which actually tees up exactly what we are tracking for tomorrow. Spill the tea. So my phone has been blowing up all week with traditional software founders quietly asking for intros to PE shops. Total panic mode.
Because they finally looked at their own cap tables and realized the AI disruption is actually going to kill their margins. The music is stopping.
Exactly. You have these SaaS guys who thought they were worth 20 times revenue 2 years ago. Now they are trying to find a chair before the valuation reset gets them fired by their own boards.
I have zero sympathy. Look at how the big tech players are handling it. They are completely rewriting the playbook. 30% of total deal volume right now is just massive equity stake purchases. 30%.
It is brilliant structuring. You want the AI talent, you want the tech, but you do not want an antitrust headache. So you write a giant check instead of an M&A term sheet.
Brilliant? Nate, it is regulatory evasion dressed up as venture capital. Look at OpenAI pulling in a $110 billion valuation round, or Anthropic at $30 billion. Big tech is just buying them on the installment plan.
Oh, come on. It is adapting to the climate. If I am a tech giant, why would I try an outright acquisition and spend 3 years fighting in court? I will just buy 49%. I basically own your soul, but the FTC cannot touch me.
Yes, they can. Regulators are going to wake up and realize a stealth merger is still a merger. The footnotes on these deals are basically acquisition terms in disguise.
Well, right now, the strategy is working. And while American regulators are busy chasing these AI ghosts, we are seeing wild momentum across the Atlantic.
Which is exactly what we need to talk about next. European acquirers are suddenly making the North American deal desks look completely asleep at the wheel. Tomorrow's radar.
I'm telling you, tomorrow morning, we're going to see 3 more of these minority stake announcements. 30% of total deal volume is just tech giants buying equity to dodge antitrust.
It's not just dodging regulators, Nate. They literally can't afford to buy these companies outright. OpenAI at $110 billion? No one is writing a check that big.
Microsoft would dig through the couch cushions for it if they were legally allowed to. But fine. You want something cheaper to watch tomorrow? Look at Europe.
Right, like Lupin acquiring VISUfarma.
European acquirers are quietly crushing North America right now. And keep an eye on IT services. Every managed service provider with decent cybersecurity compliance is getting swallowed whole.
Which makes total sense. Recurring revenue is the only safe bet when AI is completely resetting traditional software valuations. Founders are terrified.
They're quietly shopping their companies while the music is still playing.
Exactly. We'll be refreshing the SEC filings tomorrow morning to see who missed a chair. Catch you next time.